Well, it has been the worst year on record going back to the 1970s for the bond market. Normally, when stocks are down, when we're having a difficult stock market period like this year, investors take solace that their bonds are holding up well. That has not been the case this year. To understand why, take a look at this chart. This chart shows what's called the Treasury yield curve, and it shows different yields on treasuries for different maturities. And so the bottom blue line shows these yields available at the beginning of this year. And the best yield available, if you were willing to loan money to the U.S. government for 20 or 30 years, they would pay you about 2% per year. If you were loaning money and the maturity of those bonds were 3 years or less, you were earning less than 1% on that bond. Fast forward just 9 months to today, and the yields that are now being offered, almost from 1 year out all the way to 30 years, are 4%. So we've seen a huge move up in bonds, and that has been the reason that the price of bonds have come down as much as they have so far. The silver lining is, for bond investors, we've been wanting and looking for higher yields for these bond investments for years, and finally they're here. So it's been difficult and painful getting to this point, but from here forward, the outlook is much, much better. For our clients who have significant assets in bank accounts, in savings accounts, take a look and see what you're getting, what you're earning now on those savings accounts or checking accounts. In some cases, your bank may have raised rates in line with the rise in rates, and you may be earning much more. Or in other cases, maybe not so much. And so we do think this is a good opportunity to see what you're doing there. And there's some good alternatives now. Many money market funds, short-term CDs, or short-term treasuries are yielding much, much more. And so you do have an opportunity to earn a much better yield on your short-term cash as well. So bottom line, we've seen rates move much, much higher this year. That's been very tough on bonds so far, but it does mean that we have good yields from here going forward.